Hello and welcome to the clients of Escala Partners. My name is Stephen Dickinson, Investment Analyst in the Chief Investment Office at Escala Partners. Today I'm joined by Greg Hyland, Head of Capital Markets from CBRE, and Hugh MacDonald, Head of Capital Advisors from CBRE. Greg and Hugh, welcome. How much are macro events playing into commercial real estate activity at present?
I think, Stephen, if we look over the last, preceding 24 months, the macro was really going against real estate. We had an environment where interest rates were going through a tightening cycle, with the exception of Japan, which maintained exceptionally loose monetary policy. We've really now turned the corner, and we've started to see it in our business that transaction volumes are responding to that drop in interest rates, and there's a degree of confidence that the peak of the interest rate cycle has passed. So we're quite optimistic on the go forward for the second half of this year.
In terms of views on commercial real estate, is there a divergence of views between domestic and offshore investors in the relative attractiveness of Australian-based commercial real estate at present?
There is an increasing concern around Australia about the regulatory environment, in particular, some of the taxes that are being levied to foreign investors looking to place capital into the Australian marketplace. So I'd say that the term of sovereign risk is starting to become front and center, and that diverges between some of the states which have differing policies. And if you step back from it, foreign investors are a huge contributor to investment demand and scope into the commercial market in Australia. So it is a cause for concern. But when you look at what the alternatives are across Asia Pacific, the bookends really for developed markets in Asia are Japan and Australia. So Australia is still front and center, but there is that increasing concern around regulatory creep.
Just on Japan, we're increasingly hearing Japanese institutions becoming more interested in the Australian commercial real estate market. Are you seeing any signs of that?
Absolutely. Our firm has been engaged in some of the largest transactions that have occurred in the Australian commercial market with some of the mega Japanese developers and Japanese corporations. We've seen that trend emerge over the last 24 months. They've not just been active in Australia, but they've also seen increased activity in Southeast Asia, and India is a place where they've started to turn up in the last 12 months. So we expect that trend to continue. One of the things in Japan is the demographics in Japan, are working against real estate. The cities of Tokyo, Osaka, and the big cities continue to expand, but overall the demographics and population is declining, and Japanese companies tend to think long term, and they're looking at markets where they can secure growth.
There's a lot of press around China's property sector at present. How are you viewing China? Is the property sector as bad as some of the press suggests?
Yes, it is. They're going through a huge period of adjustment. It really, I think, reflects what Japan went through 25 years ago. They've entered what we see as a deflationary spiral. If you look across all the categories, office, retail, industrial, all of those sectors are materially oversupplied. In response to that, the central bank has dropped interest rates to, borrowing costs are now all in less than 2%. So we're heading to an environment that we see as pretty deflationary, and it's going to take some time to work through the overhang in the marketplace.
Just in terms of your comments from what you said about China, are you seeing the demand for Indian-based property, are you seeing that improve?
Yeah, absolutely. I think investors are really looking at what's next from, sourcing, developing market exposure at scale, and all of that points to India. And India is really at the starting gates of what we see as a fairly material real estate boom over the next decade, provided, the politics remain quite stable. Every sector is generally materially undersupplied. Demand is huge. And just to put some context, India is our biggest leasing market. So we lease more square feet in India for office than any market in the world that we operate on a per square foot annualized basis. So it's a huge underlying demand in the sector. Sectors like retail are quite nascent. So organized retail, same store sales are growing at teens plus per annum basis. Logistics is hugely sort of emerging now, particularly with e-commerce take up in India starting to really accelerate. And then the residential market, you've got a growing middle class. When you look at the demographics of India compared to China, the population in India is continuing to grow. So we're extremely optimistic around the future and the outlook for India.
And I know it's early days, but have you started to see institutional investors start to move or look at that market?
Absolutely. So I think, fortunately, unfortunately, some of the politics, and this we're referring to geopolitics, has made China a challenging destination for some groups to look at. So, that demand has really shifted towards India. And it's not just, it shifted to India partly because of that, but partly because of the opportunity set that India provides and the growth that's ahead of it.
Just in terms of from a macro perspective and Australia, do you see any differences between Australia or what are some of the changing trends versus other parts across the globe and in particular the Asia Pac?
Yeah, I think, Stephen, if you look at developed Asia, the demographics are actually quite challenging. I mean, Japan, South Korea population is that they've actually reached peak population. In the context of Australia, and if we look at the OECD, Australia actually has the highest population growth of any country in the OECD, and that's a really strong macro driver for demand of real estate, be it residential, be it commercial, across all sectors. So it's a positive tailwind for Australia. Yes, it's causing some issues on the ground now with, is it enough, is it too much? But, it is a really big macro driver for real estate, and Australia's top of the tree in terms of that when you look at it in the OECD context.
And if you can translate that into numbers and what it means in practical sense, I think that over a 5-year period, which we're sort of already entering, 2.8 million incremental people in the Australian sort of population, and you think about that in context of demand for retail, office, logistics, industrial, residential, it's Brisbane. So it's a pretty significant driver of incremental demand if you sort of think about it that way.
Private credit has significantly funded the real estate sector over recent times. Have you seen any change in this particular thematic?
Yeah, I would say in terms of private credit, we've seen a huge, I suppose, structural shift from investors, particularly as the market adjusted. The returns that they could achieve in private credit reflected equity returns for a decreased risk. We see that balance is probably starting to shift now as asset values have adjusted. And what I mentioned earlier around the macro turning, we believe that equity returns on the go forward will probably exceed those of credit. Whereas in the last 24 months, the credit returns had exceeded what equity returns had been delivered for the risk that was being taken. That said, we do see that private credit is here to stay, and particularly in Australia, it's quite nascent. It's really, I suppose, accelerated over the last 4 or 5 years, and we expect that the importance of that in the markets in Australia is only going to increase over time.
How are you viewing the construction industry in general? How's that playing out in terms of the real estate market and particularly private debt investing?
I think a few things. Construction inflation, and it hasn't just been an issue for Australia, it's been broad-based globally. So we've seen construction inflation anywhere from 25 to 50% over the last 3 years. Now, what that's sort of meant is it's been extremely difficult for developers to stack up sites economically if prices haven't kept up with the pace of that construction inflation. So in a roundabout way, it does underpin values of existing product because you're buying existing product at well below replacement cost. That's good in the near term, but as you go further out, continued construction inflation does impact on, I suppose, affordability. So that cost needs to be passed on to the consumer or the end user. So the issues, I think, in Australia, where in some instances infrastructure is crowding out capacity for spending into, I suppose, residential or other commercial sectors, could exacerbate sort of some of the supply constraints. So the construction, I suppose, industry impact on our sector is huge. And that one has really been inflation of cost. And two is really availability of contractors as well as capacity in the system to meet any supply shortfalls. So whilst it's good for owners of existing assets, it does exacerbate some of that affordability issue.
Are you seeing those pressures in the construction industry though ease in the last 6 months?
Look, I think from a materials perspective, yes. I think what we see is, particularly with a slowdown in construction in China, there's a huge materials, I suppose, construction materials installed base in China. Some of those materials now, as China slows, will need to find a new home. So from a materials perspective, we're hearing prices have plateaued, in some instances have come down for certain components. It's probably the labour input, which we don't think changes. And also productivity of that labour is quite low. We hear stories where site productivity is down to sort of 2 or 3 days a week as opposed to higher productivity. So it's a combination of probably the materials have plateaued and some has come off. It's really that labour and productivity of that labour is probably where work needs to be done.
And the availability point's a big one as well in certain markets. So Queensland, for example, with the Brisbane Olympics coming up, that's already creating a perception around whether or not it commercially makes sense to undertake significant construction or development in southeast Queensland because of that availability issue. So it's a long way out, but it's already beginning to manifest itself.
In terms of valuations at a higher level, what's happened across some of the different sectors, what you're seeing globally or in the Asia Pac, particularly in office, retail, industrial?
Yeah, I think when you look at the adjustment in interest rates, we've definitely seen an expansion in cap rates has resulted in a corresponding drop in values broadly across the board. The exception to that has really been Japan, which has operated under an ultra loose monetary policy where values have actually increased over that same period. Our view is that the valuation cycle in terms of derating, I suppose, of expanding cap rates is now over, and that we expect that the macro with regards to interest rates will drive valuations on a go-forward basis. That's with regards to the multiple. When we look at the income side, during the period of cap rate expansion, we've actually seen the income side hold up quite well across all of the office sectors. And increasingly, because of construction costs, the economic rents to bring on new supply is now quite prohibitive. So we think that the dynamics for commercial real estate are really set up well, where we're going to have tightening cap rates and rental growth. So they're the two drivers of value. So we're very optimistic in the near-term growth of the sector.
Just in terms of transaction activity at a higher level across the different Asia Pacific regions, how's transaction activity been across the different sectors?
Surprisingly resilient. I mean, we came into this year cautiously optimistic that the macro we talked about earlier was going to play out. I think some of the, I suppose, speed bumps along the way was Liberation Day and what tariffs may mean for real estate. We kind of feel that we got through that, and that's not to say that there could be more issues arise with regards to tariffs, but in the major markets, Japan transaction volumes have held up. South Korea, we've had a pretty material rebound in that market on the back of 3 or 4 rate cuts. Australia, we've started to see an acceleration. I think the one area where we haven't quite got back is office to full capacity, but all the other sectors, retail, industrial, have really performed quite well. And then, where I'm sitting in Singapore, interest rates have dropped materially and we've really started to see a rebound in transaction activity. So, I would expect that would continue into the second half of this year, provided the policy settings stay where they are. And there's obviously, geopolitical tensions around which could cause some issues. But as we sit today, we're reasonably comfortable with what the outlook for the second half of the year is going to be.
Just in terms of that office sector and maybe a focus in Australia, how have Australian major office market valuations compared to offshore markets such as the US and the Asia Pacific?
The way we look at office now, and office values have definitely corrected broadly across the board. I think the way that I suppose the end users look at office and the way that we've seen office, the highly amenitized modern office has really performed quite well. And rents are, in a lot of these markets are at record levels. Really where we've seen some stresses in the secondary office space, that is what we classify as being commoditized. Those values have really suffered quite significantly. And if you look at some of the international markets in the US, some of the value destruction is to the point where these buildings have become obsolete and need to be repurposed or redeveloped into alternative uses. We haven't seen that extent of value destruction in the Australian context. But I think on a go forward, the large institutional clients that we deal with, typically, they're really demanding to focus their capital towards major gateway city locations and the best quality office space that's the best amenitized in those markets. And what we've seen is they've outperformed from an income perspective over the near term, and we expect that to continue.
Has there been a difference in valuations across the major CBD markets within Australia? In particular, Melbourne sounds like it's a particularly challenged market.
Yeah, I think if you had to categorise it at the moment, where global capital, global investors look, and even the Australian institutions, it's really Sydney CBD has been where the activity or the recovery has been led so far today. I think your comments around Melbourne are relevant. I think the work from home phenomenon has really probably impacted Melbourne more. And then some of the policy settings around absentee land tax, etc., have just exacerbated, I suppose, some of the interest in the Melbourne market. So some of our clients are now looking at Brisbane. It used to be really Sydney, Melbourne, Brisbane was kind of the pecking order. Some of our international clients are now focusing more towards Brisbane. They feel that that's a better medium-term opportunity set. Now, that said, Melbourne at some point, it will represent a deep value opportunity, but as it sits today, there's some challenges that they still need to work through.
So that, in terms of when we hear about vacancy rate, that vacancy rate is you say it's more acute in older office buildings along with those outside the CBD core markets?
Absolutely. So quality tenants have really gravitated to those more modern buildings, larger floor plates, highly amenitized, near mass transit. The older quality stock is really struggling relative to that newer product.
One of the things we hear is those valuation differentials between the different grade of those office assets, particularly prime versus lower quality. You're still seeing that play out?
Yeah, I think so. Like, we've definitely seen a lot of the larger investors rotate their portfolios from some of that older product and try to concentrate it into newer, as I said, assets that are in core gateway locations. So that there is starting to be a real bifurcation between the values of those top tier office assets and what we refer to as probably more commodity office.
Just from a valuation perspective, when we look at that prime grade office, what's the feeling? Are we getting close to the bottom now?
Our view is in Sydney CBD, we are at the bottom, and our view that was Q4 last year or Q1 of this year. So we've definitely seen a tightening of availability of potential product in the marketplace. I think a lot of the large institutions that needed to reweight their portfolio had occurred. So the buying opportunity in the Sydney CBD has decreased demonstrably from where it was 12 months ago. So we firmly feel that there's a bottom in place in the Sydney CBD. And that will sort of start to spread to the other markets across the eastern seaboard as that CBD market continues to tighten.
Just on that office, the comment about office, we're starting to see that bid-ask spread start to narrow for potential transactions. I know a lot of the transactions, the number, 20% discount was bandied around. Are you starting to see what is the number for prime grade office, and is that spread starting to narrow?
I would say, yeah, absolutely. So a lot of office landlords have worked through the valuation cycle, so those right down to the curd. So it's becoming easier for landlords to strike deals at or very close to book. As the cycle turned, discounts, wasn't unheard of, discounts between 20 and 30% was the bid. That's now closed to very close to book. And that's a combination of confidence in the marketplace, but also, those book values have been written down now to adjust the reality of the current situation.
Last one, just on the office sector, just going back, this whole working from home dynamic, how does that vary across the different regions in the Asia Pacific?
I think, as I said in Singapore, I think if you look at every office market from Singapore north up to Tokyo, culturally, the expectation was most people work in the office. I think the cities that the Asian cities are generally very large and very dense, and most people live in smaller accommodation or apartments. So the conducive nature from work from home is probably not as available in Asia as it is in Australia. Australia was probably somewhere at the halfway house between the US and Asia in terms of work from home. And there's certain states in Australia which had, I suppose, more prevalence of work from home. What we have noticed across the board is companies are really starting to have firm policies around return to office. There is always going to be a degree of flexibility, and some companies have gone further out on the spectrum with regards to flexibility, but we've generally seen a shift from our occupier clients, and they're sort of now looking at having a firm policy for people working from the office for a period of time during a week.
Just in terms of other sectors you touched on, but in terms of the industrial sector within Australian-based real estate, how are you seeing that, and in terms of valuations there, and then maybe also the retail sector?
Sure. If I look at retail to start with, it's probably been the star performer. And for a couple of reasons, it's been the one sector that's had the most negative connotations and rebalancing over the last 4 or 5 years. So it now represents a pretty deep value proposition. So entry yields in the retail space are extremely attractive and some of the highest when you compare them to industrial and office. A lot of the rental rents in those centres have been rebased, and more importantly, the supply is virtually non-existent across the board. So the story on the go forward is quite optimistic. And if you overlay that, a lot of these centres are quite land rich in central locations. So there is potential for expansion or adaptation for other users. So we've seen a really big uptick in retail, or the appetite for retail. Then if you look at industrial, where we sit, the Australian industrial market, from an occupier, from a rent performance perspective, has probably been the best globally over the last 3 years. Rents have gone up approximately 75%. They're now starting to trend back to more normalised rental growth, and that would be 4 to 5%. But when you look at the vacancy rate across the eastern seaboard of Australia, it sits at about 2 to 3%, which when you look at that on a global context is still extremely tight. So whilst we've had explosive rental growth, we do feel that those rents are going to go back towards trend. And cap rates have adjusted to reflect the current interest rate environment. So whilst the fundamentals are quite strong around industrial, we feel that the growth in that sector is probably going to moderate more towards a normalised growth rate.
One of the sectors we hear a lot about is build to rent. Maybe where are you viewing that sector? Has that been a growth area more recently?
If you look at the living sector broadly, from an international perspective, it's one of the preferred asset classes. And there's a lot of optimism for capital to place into the Australian build-to-rent sector. When you look at housing shortfall, vacancy rates broadly across the country at sort of frictional levels. So the dynamics, when you look at the macro, the BTR were very, very strong. It's been quite difficult for groups to place meaningful amounts of capital. And I think that's really a combination of factors. Was the tax or the policy settings took some time to get into place. And then construction costs really exploded. So the economics of actually getting a project out of the ground became quite challenging. We see that there is continued interest into the sector, but it's probably gone slower than what most investors would have hoped at this point in time. But that said, we do see that it is a sector that the government policy will come around and start to. So I think, Stephen, just to touch on, it's been challenging so far to date to get to scale and BTR, but what we are starting to see is as construction inflation starts to moderate and also the government policy settings with regards to MIT become clearer, I think that investment into the sector will start to grow and will mature over time. I just think people's expectations around being able to place a lot of capital very quickly were probably misguided.
Just in terms of outlook at a high level, the largest risk still facing the commercial real estate market for investors?
I would say I think the geopolitics are a risk. There are wars going on around the world and there's political tensions. So that is one that's a risk, potential risk out on the horizon. I think in the Australian context, the policy settings or the consistent adjustment in policy settings is a potential risk appetite. Capital's generally fungible. It can go to where the best opportunity set is. And Australia is an extremely attractive location, but constantly changing the investment rules and regulations does create cause for concern. And then, if inflation does break out and the cycle of interest rates unwinds from where we are today, we don't see that as being the case. But potentially, if inflation does return, then what does that mean for rates? So they're probably the three things that I would consider. The two probably more macro, and then the Australian policy setting issues are probably the final piece.
And just finally, in terms of sectors, what's looking as a house view, what's looking the most attractive, the unattractive at present?
Well, look, I think there's an argument for all of the sectors at the moment. I think the macro is very, very favourable for commercial real estate on the go forward. So for different reasons, which I mentioned earlier, retail is extremely attractive because it's a deep value play. Logistics and industrial is a great proposition because of where it is structurally with regards to vacancy and where demand has been coming from and that shift to e-commerce. So it has some favourable tailwinds as well. And then office, again, has some tailwinds with regards to limited new supply. The cap rates have moved out. So each sector you can have an argument that there's a reasonable, strong tailwind behind it. And we just touched on data centers. The demand for data is huge. So at the moment, we're pretty optimistic. We've had a pretty challenging couple of years as we're adjusted to a higher rate environment, and that's really impacted values. That's come to an end now. So that fundamental macro overlay is going to create, we think, a pretty strong tailwind across all sectors. And then when you get down to each sector, it will perform because it has its own unique characteristics.
Okay. And added to that dynamic is what you touched on earlier in the call with the demand for offshore investors for domestic property.
Yeah, look, I think Australia continues to remain, when we look at it, and the way we look at Asia Pacific, we divide it between developed and developing Asia. And developed Asia is really Japan, South Korea, Singapore, and Australia. And in terms of accessibility of product, it really is bookended by Japan and Australia. So it's hard to see those dynamics changing, despite what I said around some of the policy settings. It's still a pretty favourable and attractive environment to invest into.
You mentioned in the early part of the call, we talked about Japanese institutions increasingly becoming interested in domestic commercial real estate, but just in terms of offshore investors in general, outside of the Japanese institutions, what sectors do you think they're becoming most interested in at present?
Despite my earlier comments around living, I think living still is front and center if it is available. So any living asset that we've brought to market recently, we've found that the bid has been extremely strong and extremely deep. The thematics around logistics and industrial hold true, particularly when you look at the overall fundamentals in Australia. And then the retail has really been the unloved child, and that's starting to come back. So there is something for everyone, I think, in the Australian market at the moment, but the global thematics around sheds and beds remains intact. But some of these other sectors that have been beat up, like retail, they're starting to just become such deep value that groups are coming back to it.
Greg and Hugh, thank you very much for your time today. I think we've gained some very topical insights into the commercial real estate sector and some of the trends CBRE are currently seeing. I hope everyone enjoyed the update, and we look forward to sharing further information with you going forward.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. Escala Partners is a corporate authorized representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.